I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, CEO and President of InsideTrack.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Just before we went on air, we were talking about how 3 other previous interviewers had called you back because they were so impressed with your track record going back to the end of last year when things started to go sideways. Maybe you can tell us about that and how that relates to what's going on today.
Well, in the context of what we were discussing, it was really the analysis on gold and silver, and I know even you and I had a couple of interviews mid-year, too, that were just kind of recapping my outlook for 2016. Back in 2013, 2014, when I started discussing my expectation that 2016 would be the golden year, I specified that or clarified that so people would understand exactly what the cycles were showing to me, and that was that we would see a very strong advance in the first half of 2016, that would be the type of rally that would confirm that a bottom had formed, as opposed to just a reactive bounce in an ongoing bear market. And that if we did see that, and if gold got above certain key levels, around the 1350 level, that would all confirm that a multi-year bottom had formed, but it would also likely time and pinpoint the end of an initial rally, and that you would then get a pretty sharp pullback into the fourth quarter of 2016, and that is when the secondary cycle low is expected. Ideally in November. There's actually a couple of specific weeks where the greatest synergy of cycles is pinpointing. And so that outlook has just been powerfully reinforced, especially by the latest downdraft in gold and silver coming in early October. And those markets, those metals just continue to adhere to the intermediate and the longer term cycles, which just reinforces to me and gives that much more credence and credibility to the outlook for 2017, 2018.
Well, of course, people do want to know what the outlook is. So what is it?
From a big picture perspective, it's all a developing bull market that I'm expecting. That I think on balance it will be an advance that began in late 2015, so it sees a secondary low in late 2016, and then begins to rally more convincingly in 2017, 2018. But even within the first part of that, the way that a pretty strong or resilient bull market takes hold is that you get a kind of a stair-step progression of ascending lows. It's not a straight-up event. And so the same way that you just saw a 6 to 7 month surge in the beginning of 2016, and you're now seeing a 3 to 4 month, and it could expand a little beyond that decline, I think that you will see something similar to that, but on the next lower degree. So it would be perhaps a 3 or 4 month rally, and then a 2 month pullback into a higher low. And that's the way that these waves and these trends typically unfold when they are a sustainable bona fide bull market in the making. So I think we're still going to see plenty of volatility through the middle, even late part of 2017, but it will be with a developing upward bias and upward trend, and as time goes on, it will begin to convince more and more investors that, yes, this is the start of something much larger, but it's not going to be easy unless you just have a buy and hold mentality. Not going to be easy to get in and out if you're not staying very closely in tuned with a lot of the technical indicators and the cycles that are lining up. But on the whole, I think that we are going to see a stronger move in 2017 and then even more so in 2018.
Is this a good time to believe in averaging?
Well, that's what I'm saying. If it all comes down, everyone approaches the market differently. So, there is no one-size-fits-all approach, but if your risk tolerance and your overall trading strategy is something looking out for a few years, then we've now started to test kind of the intermediate support levels, even though I think we're going to see spikes below them. It certainly is a point where you start looking at that again. But, I had my 3 to 6 month and 6 to 12 month buy signals triggered back in mid-December. I think we even discussed them in an interview back then. And so I'm now waiting for a second signal similar to that to look at adding on to long-term positions leading into mid-year. It was just a case of holding onto those initial buy signals, and now I'm waiting for my work to line up, and it does look like it's going to be probably in November when the whole setup is complete and ready for a new 6 to 12 month or longer buy signal, because there are certain patterns that need to unfold and kind of a bottoming process that the market needs to go through before that magnitude of a signal sets up and then is triggered. But just from a general averaging standpoint, yes, we're starting to get back into those zones where it's a good idea to at least add a small percentage onto a core position.
Well, I'm taking a look at the panic that happened 2 weeks ago when gold did its sudden plunge. Did people needlessly sell off?
I don't think so, because I've been saying since early July that we had to have a good, significant drop to really make this a more authentic bull market. I'm not sure which is the best adjective to use, but something that has good infrastructure to it and a good structure that will support a more significant advance. So it comes down to what your objectives are. If you had bought in December, January, and all you were looking for was a multi-year bull market, then no, there was no reason to sell. If you're looking at 2 to 3 month, 3 to 6 month moves and trying to capitalize on them, well, the time to sell was when the sell signals were generated in early July and then again in early August. So it certainly was an expected sell-off, and something that if you're trading on 3 to 6 month, even 6 to 12 month basis, yes, you want to be reacting or being more proactive, really, getting ready for those type of swings in the market. It all comes down to who the target audience is, or who we're discussing with a question like that.
We'll have more with Eric Hadik right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Eric Hadik. Eric, do you have a similar long-term chart looking at oil?
Oil, I am still sticking with the analysis that we discussed late last year and early this year, that major cycles were looking for a multi-year low in the first quarter of 2016. A secondary low is most likely in around January of 2017, but as far as a bull market developing, I still think it's going to take more time. I think that certainly the rhetoric and the communiques being put out there from Saudi Arabia and then Russia are kind of the opening salvos in a war against low oil prices, but I think it's going to be quite a while before something really takes hold there to initiate a more sustained bull market, something that could get crude back above the $60 level and continuing higher. I still think that's out on the horizon a bit. And it's one of those things that so much of it, the communications put out there are a bit deceptive, and I'm even thinking most recently of Russia just in the last few days jumping on board and saying, yes, we're now ready for a freeze in production. Well, the last 2 months, they've just pumped out record post-Soviet high production numbers, over 11 million barrels. So it's kind of like, okay, they wait till they get to the absolute maximum, and then they say, okay, we should all freeze output now. Well, everyone else, there may have been certain countries that have had struggles for one reason or another. They're now at probably nearing the top of their capacity, so they say, okay, now's a good time. We've finally gotten production up as far as we can. So them agreeing to a freeze at record high production levels really doesn't mean a whole lot.
And of course now we don't have an organized world. Back in the 70s and 80s you had OPEC, who could turn the taps on and off and control prices. Even if OPEC went away, how much of an impact would that have?
Well, yeah, like you're alluding to there, it's so spread out and so disorganized that you look at so many of the countries. Well, you have perfect example of Iran just coming back into the world oil production and selling arena, and they're going to be looking to ramp up production as rapidly and for as long as they can right now to recoup some of the money and some of the production that they've missed for a couple years. And you have nations like Venezuela dealing with such economic struggles that they certainly love it when there's some rhetoric out there that says, okay, it's time to freeze production and prices bounce a bit like they're doing right now, because at least they're getting a higher price for their oil. But many countries really can't afford to start scaling back production. They may, those that are near the top of their capacity may jump on board and say, yeah, let's freeze production. But what does that really mean? If these production levels are justifying somewhere between $30 and $50 a barrel, And then other factors like economic activity or global economic activity are what drives the in-between swings. Okay, so they all freeze production here, but you have another downturn in global economic activity, and crude will be right back down below $40 a barrel, even though they're freezing production.
And do you have any outlook on what the prices could be when we go into the traditionally low times, December, January?
I'm definitely looking at some support around that $35 to $40 a barrel, and that's on the crude futures that I'm looking at, the WTI. But that will become more honed, more specific as the next month and a half play out. So I certainly will be publishing more specific targets and support levels, but right now, just generally, it's looking at that $35 to $40 range as support.
What about other commodities?
I think that we are seeing, just like we're discussing with oil and just like we're discussing with precious metals, even though the time frames are a little bit staggered, I think you're in this major bottoming phase in starting in late 2015, going through 2016, and that 2017, 2018 is when I'm expecting more of commodity price inflation across the board. And I think there's going to be different drivers that push the diverse markets higher, but there could also be some overriding factors that support all of them. And one of those I'm thinking of is just continuing struggles with some of your lead fiat currencies, the euro, and you've seen a stronger yen lately, but things are starting to show a little bit of vulnerability there. But really, the dollar, too, is what I'm looking at. I still have said all along, I think the dollar has one more advance into second quarter of 2017. But if it really does start to go through a topping process, that could be one of those factors that maybe as you're looking at 2018, help propel commodity price inflation even higher. So I think it's going to be a multi-staged process here. There are certain commodities that have already given long-term buy signals, and we're watching their bull markets develop. Others, I think, like even when I look at some of my analysis in certain grain markets, that could wait till the end of this year for a double bottom type of low. But there's a lot of my work showing that 2017, 2018 is going to see bull markets in the majority of commodities.
Eric, is there any one particular one we should focus on, say copper? I've noticed copper, it had a very good gain. Usually that's an indicator that the world's economy is picking up. Now it's dropped back a bit. Is copper a good indicator of what's going on?
It certainly is an indicator of economic activity and upturns in economic activity, but I don't know that that's the driving force or scenario that I'm looking for in these coming years. That it doesn't necessarily, that would be more of a, I guess it would be more of a demand-driven type of rally. I could actually see things where it's a mix of, I've got long-term weather and drought and food crisis type cycles that are telling me we could see some stresses on crop production in the coming years. I've got other work that is showing just this major generational shift from paper assets, which, bonds and stocks, both showing that the coming years could see some substantial sell-offs. That shift from paper assets back to hard assets. And so to look at your classic lead indicator like copper, and often people will look at lumber too, that's indicative of just a purely economic activity-driven bull market. That's not really what I'm expecting here, so it's more, I need to see a bigger context around that, something like copper or lumber or other drivers that people often watch for signs of an upturn.
How big of a change in the markets do you expect relating to the results of the U.S. election?
I think that you are going to see some big shifts, but it will probably be in fits and starts. I think that we're going to continue to see growing uncertainty leading into the election and possibly for the weeks after. Who's to say what could unfold? This is one time when the one constant is change in this whole election cycle, and the least surprising thing between now and election would be more surprises. So the whole thing is one giant contradiction in terms, or oxymoron, whatever you want to call it. So I could see, struggles that even create some turmoil after the election, and that type of uncertainty certainly will spook particularly the equity markets. But then, if you get a sharp sell-off in equities, you often get a reactive drop in commodities, although it's usually short-lived. I think that there are other factors, like when I'm talking about a final rally in the dollar, but a major top probably in 2017, that could also be linked to political parties and political ideals. And you even going back over the last 30, 40 years, you can see those swings in the dollar very closely correlated to swings in the political parties in the U.S., with one party really looking at a lower dollar and increasing exports as being a good thing, and another looking at a stronger dollar and lowering deficits and ramifications of that being the preferred route. So I think that the election's going to have profound impact. I think that as you see other countries or blocks of countries respond to whatever the results are, yes, you'll be able to trace a lot of it back to the election, but I'm looking at other factors as well.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrack.com, Inside spelled INSIIDE. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.